Moving on, it's great that we calculated those ratios, but what do they mean in terms of risk analysis for the company? So we'll start with solvency. We see that there are some more concerning risks with regard to the company's long term ability to pay back its financial commitments. While Viacom's debt to assets ratio was incredibly favorable, their debt to equity showed a problem, potential problem, we'll say, with how much of the company is being leveraged in order to compete in the rapidly expanding industry and makes the company a little bit more risky in the long run. Analyzing these past 2 years, we see a general downward trend in a number of crucial ratios that investors must take into account. However, it is essential to note that the increased competition and new changes to the market require the company to invest heavily in research and development in order to keep ahead of their rapidly developing industry. Moving on to efficiency, we see an overall increase, which is greatly beneficial to the company. The company increased in overall efficiency collecting credit from 2016 to 2017, which indicates it's indicative of their non-conservative policy regarding the extension of credit that we discussed. There's also an increase in that inventory turnover, possible excess of inventory or weak sales, and Viacom was overall more efficient in 2017 compared to the industry, which is really important to take into account those industry averages. Operating performance, with regard to that, we saw a drop off in both gross and operating profit margin, which appears risky. However, the net profit ratio shows a really promising return as the company continues to innovate and continues to stay ahead of its competition. So, despite decreasing in those first two profit margin areas, the fact that we see an increase in net profit does lead us to believe that there is a lot of promise in the investments that are being undertaken to see returns.